Hey everyone, glad to have you here with us today. I'm Alex Slawsby, Chief Growth Officer here at InnoLead, and very excited to welcome you to our webcast, Why Your Corporation Should Be Launching New Ventures and How to Get Your CFO on Board with my friend Elliott Parker, CEO of High Alpha Innovation. We'll get started in just a minute. While everyone's settling in, we'd love to read where you're coming from. So if you want to take a moment and put in the Zoom chat where you're joining us from, please do. Elliott is in beautiful Indianapolis. Is that correct? It's gorgeous, right?
Beautiful, sunny Indianapolis. I wish, not today. Some days it is, not today.
Sunny in the 80s, a beautiful winter day, probably. In Boston, it's a bit dreary, gloomy here as well. Looks like, oh, wow, Germany, fantastic. Cali, Indianapolis. Carrie from our Dallas, fantastic. Big football games coming up. Yeah, well, Megan, our colleague, Buffalo, Bills, Cowboys. A lot of folks are saying if that's the big game for the Super Bowl, that'll be great. Oh wow, Green Bay, excellent. Welcome. Cleveland, wonderful city. Bengals. Wow, we got representation.
Strong Midwest contingent today. It's great.
A lot of people are probably happy that it's not the Patriots. We've had enough fun, and now we can just, some misery. So anyway, welcome everybody. Once again, I'm Alex Slawsby, Chief Growth Officer here at InnoLead, and I'm excited to welcome you to our webcast today. Today's webcast is being recorded, and we will share both the replay and the slides after the fact down the road a little bit. And as we go, please take advantage of Zoom's Q&A and chat features to share questions and comments, and we'll make sure to take time at the end after Elliott's done to answer as many as we can and address as many comments as we can. So let me introduce Elliott, and then I'll hand it over to him. Elliott Parker is CEO of High Alpha Innovation, a venture building firm whose mission is to help the world's leading organizations innovate through systematic startup creation. Prior to his current role, Elliott led business design at High Alpha, the Indianapolis-based venture studio. He's also worked in strategy consulting at Innosight. We were colleagues some years ago, in corporate venturing, and as an entrepreneur to bring new ideas to market. So Elliott, the floor is yours.
Alex, thanks. It is great to be with you all today. We're going to talk about a really important topic today, and that's how to unlock more innovation and insights through venture building. It's a really important topic because I think the world is better off when large organizations are successful at solving important problems. And the problem is this requires experimentation and learning, which large organizations, unfortunately, are not optimized to do. And so we're going to talk about how to get around some of the obstacles, how to gather insights through systematic experimentation, and how to launch ventures that change the world and make it better. We'll talk also in detail about how to get your company's leadership behind the effort, because that's an important part of it. So as we're going, as Alex mentioned, feel free to use the comment section. I'll be tracking that as we go and try to answer any questions that pop up. First, a brief introduction to High Alpha Innovation. We're a venture builder. We're a team of about 40 venture building experts who co-create advantaged startups to solve compelling problems. And what does that mean? Well, co-create means that we partner with universities, corporations, and entrepreneurs to launch new ventures. And our goal is to enable the corporations that we work with to create world-class venture building operations. Now at High Alpha, our original venture studio, we've been building new startups for the last 8 years, doing this systematically. We developed the playbook, a playbook that works really, really well to systematically create new ventures. We pioneered the venture studio model, and we've learned a lot since we started. To date, we've launched almost 50 companies. We've invested in many more. And in 2020, we created a new business called High Alpha Innovation that I run, that makes our venture studio playbook accessible to universities and corporations. So we build advantaged startups together with our partners, meaning that the startups that we build are more likely to achieve significant outcomes and to get there faster because of the way that we build them and what we do. And we build ventures to solve compelling problems. What that means is we only launch companies that we believe can become billion-dollar businesses over time. What we do is not innovation theater. We'll talk more about that. The point here is to get traction, to take action and get points on the board really quickly and efficiently. So corporations work with us for a lot of reasons. To summarize, most want to make transformative innovation more tangible, to get results more quickly, to do it for far less expense. I started High Alpha Innovation after years myself working in corporate innovation, corporate venture capital, and being dismayed and frustrated by the results. It's really, really hard, as many of you know. So we aim to be the easy button for our partners, corporations that are new to venture building or those that have been doing it for a while, and everyone in between. We help our partners put those points on the board, as I mentioned. And the end result is really rapid learning. It's the creation of strategic options for our partners. We recruit and incentivize world-class entrepreneurial talent to run the ventures that we build. And we figured out how to unlock new approaches to funding innovation, which we'll talk about today. That those approaches solve some of the hurdles that are otherwise get in the way of transformation. Since 2021, we've launched 14 independent startups, each with a corporate or university partner, and each with a world-class founding team running the business. If I have time today, I'd love to tell you more about the amazing things that all these companies and their founding teams are doing and what the impact has been for the partners that we built these businesses with. Don't have time for that today. That's another topic for another day. In 2023, we plan to launch 20 more companies with our corporate and university partners, and we'd love to build with you this year if that's of interest. Now, before we go any further, what I'd like to do is Megan's going to do a couple of quick polls for us just to get a sense of our audience. Megan, if you want to put the first one up, love to see what kinds of organizations y'all are from. And so go ahead and vote. We'll see the results pop up here in just a second. Just get a sense of who's in the room today. All right, let's pull those results up and see how we did. All right, so a good mix. A lot of you are working on innovation corporations, several from startups, entrepreneurs. Great mix. Welcome all. This content I hope will be relevant to each of you today. One other question, this is particularly relevant for those of you who are inside of large organizations. Curious the extent to which your organization is already experimenting with venture building. So if you could go ahead and answer this question too, we'll just get a rough sense of where people are in the venture building journey. And if the answer, by the way, is yes, go ahead and put in the comments section how it's going. Is it working well? Are you achieving success? Are you struggling? What in particular are you struggling with? If you are struggling, we'd love to know. We'll try to address some of those points today. All right, let's see what answers we got to that one. All right, so good mix. People have been trying it, some who are new to it. Like I said, if you are, let us know how it's going in the comments section, how it's been so far. Feel free to put in specific hurdles that you've encountered if it's been tough or more difficult than you thought it would be. We'll try to talk about some of those today. Before we jump into the thing, what I want to do is just make the case for venture building and arm those of you who are trying to advocate for this in your organizations with some talking points and some way to frame it and explain why organizations should be building new ventures. It's not intuitive or obvious that corporations, for example, should be building new ventures, let alone in some cases external startups. So let me frame it up a little bit and tell you how I think about it. First, let me just make the case for optimism. I think we should all be optimists generally, but this moment in particular is an especially appropriate time to be optimistic, maybe more so than any time in the past. Optimism explains why we're so serious at High Alpha Innovation about venture building, why I think you should be too. There's never been a better time on average to be alive. And according to almost every measure, the world's getting better, the human condition's improving. That doesn't mean there aren't big problems. There are tons of enormous problems to solve. But on average, things are getting much, much better than they were in the past. And I believe that the improvements are only going to accelerate. If you look to the future, and you look at the trends, I believe the costs of communication, of computing and energy are all going to zero. And this is creating what will create a new age of abundance. It's already here, in fact. Communication is already effectively free. The cost of computing, as measured in terms of processing speed per dollar, continues to drop dramatically, getting to almost zero. Computing is becoming more pervasive. It's more AI enabled. The cost of energy, when you measure it across centuries, is actually trending towards zero as well. Back in 1994, a researcher named William Nordhaus showed that the amount of work that once bought an hour of light now buys 51 years of light. While fusion technology is far from economically viable, recent breakthroughs have shown that it's at least physically possible. This is a really big deal. It's not crazy to think that in the next few decades, we'll have unlimited, nearly free energy. So what happens when communications, when computing and energy are all free? The answer is, we don't know. It's never happened before in the history of humanity, but I suspect that innovation is going to move even faster than it does today. Things will accelerate. And that's part of the point today. When you're in the middle of the action, it's really hard to perceive exponential curves. Our brains extrapolate in straight lines. We rely on past growth rates to project the future. But what happens when growth rates are actually accelerating? The trajectory of our recent history, it can tell us a distorted story, right? We're in the middle of an economic downturn at the moment. Progress isn't smooth. There are dips, there are cycles, but when you zoom out, the dips just become squiggles on an exponential curve. And on the left here, you see a depiction of, in some cases, what is actually about to happen, borrowed from the author Tim Urban. And on the right, you see what it feels like in the moment. It's really hard for our linear brains to perceive exponential growth. But these exponential curves are all around us. Here's an example of one I just referred to a moment ago. Now, when I was growing up, I feel like back in my day, we had to be really careful when we were dialing phone numbers outside our local area code. Some of you may remember this, some of you may not. At the time, phone companies would charge you they'd charge you extra fees for long distance calls, and they'd calculate those fees by the minute. Now, since then, communications become effectively free. And this is a new development in the history of the world. This hasn't happened before. But go back to, like, let's say the 1860s. Let's imagine you were living in New York City and you wanted to have a voice conversation with someone in California. The only way to do that would be to pay someone $20,000, get in a stagecoach. They would drive you across the country. It'd take 6 months. You deliver your message to somebody in California, and then you'd have to pay $20,000, spend 6 months, and go back to New York City. Incredibly inefficient. Eventually, phones came along and made things cheaper. But even in the beginning, as you see here in this chart, you go back to 1915, the cost of a 10-minute call across the country was $2,000 in today's dollars. Now, that price dropped precipitously over the years, so much so that in 2006, the chart ends because the FCC stopped tracking the cost. It was almost zero. Now, we don't think anything of hopping on a Zoom call with people anywhere in the world, right? We're doing it right now. It costs almost nothing. It's effectively free for many of us. Now, collision and exchange of ideas are what lead to new ideas. So human beings, we learn new skills from each other by copying individuals we admire. We innovate by making mistakes or mutations that are occasionally improvements, and that's how culture evolves. So the bigger the connected population, the more skilled the teachers, the higher the probability of productive innovations. When everyone is connected, when that network is powered and assisted by computers, and when energy is also free, amazing things are bound to happen. So the case for optimism. Additional factor accelerating the pace of innovation is what we might call technology building blocks, right? So this is the idea that through communication, early inventions are added to, mashed together, improved upon to create new and better things. The ancient Egyptians had to invent their own building blocks and things like beds and spoons and cheese. It's why innovation was so slow back in ancient Egypt. Ray Kurzweil, some of you may know of him, he explained this phenomenon in what he called the law of accelerating returns. It says the rate of change of progress accelerates because humans can use the technology at their disposal to progress faster than previous generations could without that technology. Now, note that he didn't say the rate of change stays steady. It doesn't stay the same. He argued that it actually accelerates. The rate of change gets faster. And more and better building blocks lead to an acceleration of the pace of change. So what happens when everyone on the planet is connected? When everyone has access to building blocks of AI, of healthcare, of finance, it's all callable via a few lines of code. Again, the answer is we don't know. It's never happened before, but it's about to happen. We should expect that the world will get very different. Things will get very weird very, very quickly. What we know is that technological change is likely, in this instance, to empower individuals over large organizations. And that has implications for the corporations, the way we innovate inside of them. We're already seeing this happen. It's already started. If you look at what's going on with corporations, some research done by Alex and I have former colleagues at Insight did some work looking at the duration of companies on the S&P 500. It's going down over time because of the increasing pace of change brought about by the lower costs of communication and computing in particular. It's much harder for large corporations to compete, and we should expect it to only become harder, more challenging. R&D, for example, is 41 times less productive than it was a century ago. M&A is significantly more expensive than it was just a couple of decades ago. It means good deals are harder to find. At the same time, in this environment, you see venture-backed startups that are able to access capital with relative ease. Small teams are able to access expertise and knowledge. It's easier for disruptors to take down incumbents. And we should expect it to get even easier for them over time, while it becomes harder for corporations to meaningfully innovate. Sounds like bad news. I'm not saying this to depress anyone. Remember, just a minute ago, I was making the case for optimism. What I'm trying to explain is that the old approaches aren't going to work anymore. If you want your corporation to survive and thrive, you need to try different approaches to innovation. I love this little image here on the slide. This is Insights researcher Gary Klein uses a version of this graphic to explain the challenge. In our organizations, we try to simultaneously reduce errors while increasing insights. And the reality is that you can't have both an error-free operation and learning and insights. There's an acceptable amount of error, of inefficiency, that is required to generate insights. Entrepreneurs know this really well. There's a ton of inefficiency in startups, but also a lot of learning, a really rapid pace of learning. Startups are optimized actually for inefficiency and for learning. If you want transformative market creating innovation in your organization, you have to be willing to experience inefficiency. There is no other way. So you have to find ways to create the tension that helps you source weak signals, helps you be inefficient and make mistakes. Scaled organizations are designed to avoid that. They're designed to toss aside weak beliefs, those things that contradict what the organization believes are true. But we often learn by centering on those weak beliefs, by taking them seriously, instead of explaining them away or trying to throw them out. I love this quote from Clay Christensen. Several of us here at High Alpha Innovation had the honor of working closely with Clay at the consulting firm that he co-founded. And the innovators at corporations that we worked with were usually tasked with executing innovation and investment strategies to defend against disruptors or new technologies, or to capture transformational growth opportunities, push the organization into new markets, new customers, new business models. And the innovators we worked with inside corporations were very well versed in innovation theory. They deeply understood the need to transform their organization, but they felt frustrated by the lack of funding, support, the lack of resources to launch and scale really transformational efforts. I know I felt that way when I was working in corporate innovation. Maybe you feel the same, those of you trying to do this inside of large organizations. You've got a sense of urgency because you see the opportunities, you see the threats, but you also have trouble convincing the organization to give you the resources and the timeline that you need to do what you know you need to do. And as Clay pointed out, the root cause of this lack of support is often short-term earnings pressure, right? It's a misalignment of incentives. Most organizations, senior executives are compensated based on short-term metrics like earnings per share. And so they're optimizing, think about that prior slide, they're optimizing for error reduction and for capital efficiency. They're not optimizing for insights. If you want insights, you have to be willing to make mistakes and to make a lot of them. Let me just throw this one up too. I think as a corporate innovator, you should want a lot of insights. The problem is it's really hard to predict ahead of time which activities that you undertake are going to lead to insights. We can learn a lot about insights, I think, from the world of venture investing, the world we operate in. Early stage venture capital is what's called a power law asset class. That means the majority of returns are driven by just a few outliers. And the best way to increase the probability of achieving an average asset class return when you're dealing with a power law asset class is by increasing variance, increasing diversification in the portfolio. In venture investing, pattern matching, making investment decisions on purely based on what has worked before actually reduces variance. So the goal is to capture maximum variance. In a normal distribution, like you see on the chart here, like in public stocks, for example, a smaller pool of investments will earn you an average return. In early stage venture investing, a portfolio of only 20, 30 investments is very unlikely to produce industry average returns because you're dealing with a different type of asset class. In venture investing, the average rate of unicorn production, these companies that get to $1 billion valuation or more, it's only about 1% to 2%, if that. And this varies across geographies and sectors. So to be a successful VC, you have to diversify your investments across a broad number of companies and sectors because there's no clear indication ahead of time, really, which investments are going to turn out to be those outliers. So if you believe that the asset class that you're working with follows power law distribution, then you should want to have the most diversified portfolio as possible. My point is that insights are like venture investments. Most insights end up being really inconsequential in the end, but a few end up pushing you in entirely new different directions, and they can lead you to outsized success in your organization. So to access those unicorn insights, you need a portfolio that's diversified. You need to try a lot of things. You need a lot of reps. You need to stop pattern matching because pattern matching kills variance. It means you need to stop choosing experiments based on their ability to reinforce what the organization already knows. You should be looking for anomalies, not reinforcement. It means you need to stop choosing experiments by committee. It means you need to run far more experiments and you need to do weirder things. Let me give you an example of this we see in nature. This is a picture of the Amazon jungle. My oldest son is on his way to go to grad school to become an entomologist, a bug scientist. He's wanted to do that since he is 3 years old. And when he graduated from high school, he organized a trip for me and him to go to this remote area of the Peruvian Amazon where we could go look for insects on purpose, which is not my dream vacation, but turned out to be an amazing experience. So what we do is we'd set up insect traps at night in the Amazon. We'd stretch a white bed sheet between two trees in the jungle. We'd shine a light on the bed sheet and we'd wait a few minutes for that sheet to be covered with bugs. The variety was crazy. Hard to describe, insects of every color, every type of camouflage. Show you a few here. Some of the insects had really bright colors. Others were designed to blend in. Some had crazy appendages. Others had adopted the shape of something like a stick or like mold or leaves. And over time, what's happened in the Amazon is that natural selection has produced just an astonishing amount of variation. What's remarkable is that the process is unguided. It's random. The ecosystem has no plans, no goals. Success is the natural byproduct of the learning that happens at the level of the organism. And I'll bring this back to venture building in a second. Just hang with me. Some might argue that the objective of evolution in the Amazon is to find organisms capable of surviving and reproducing. It's not true. If that were true, we wouldn't see so much divergence, so much variance. Evolution would have stopped with single cell organisms, which are really prolific, really resilient. But the divergence is a testimony to the fact that something else is going on. So an ecosystem like the Amazon uses evolution to gather knowledge about all the different ways to survive and reproduce. And as the more simple approaches are exhausted, gradually more complex forms of life are discovered. They're not because they're optimal in some way. They're not improvements over earlier forms of life. They're simply the next steps from where the ecosystem last stood. As that ecosystem becomes more knowledgeable, as it collects more knowledge about different ways to survive and reproduce, an amazing thing happens. It becomes extraordinarily resilient. Almost no matter what happens, life will continue to survive in the Amazon for a long time. The Amazon has learned how to innovate in a way that creates long-term resilience. So a few lessons that relates to venture building from the Amazon. First, no objectives. This sounds crazy in an organization, but in the Amazon, there are no objectives to evolution. There are only constraints in which the system has to operate. Evolution isn't planned. It's not top down. It's not command and control. It's messy. It's natural. It's unstructured. Limited resources act as constraints that drive selection, but otherwise there's no primary objective. The goal isn't creation of some super organism that current organisms are adapting to become. It's simply evolution is simply the result of an accumulation of knowledge, of these building blocks we talked about that represent the next possible step. If it were objectives driven, it would not be so prolific. This is a key point. Contrast that with innovation inside of a lot of our organizations, which is top down, it's planned, it's objectives driven. as a result, is typically very far from prolific. Number two, Amazon and the jungle, when it's doing innovation, experimentation, that happens at the margins. It happens in the form of mutations at the level of individual cells and organisms within the ecosystem. When those mutations fail the fitness test, it's too bad for the individual cell or the organism, but the ecosystem is stronger as a result. And when those mutations succeed, the ecosystem is poised to adopt them and to let them flourish. What's interesting, just a side note, those mutations aren't broadly communicated at first. They aren't shared. That lack of communication in the Amazon is a feature of innovative systems. It's not a bug. Contrast that to innovation side of our organizations, right? Where innovation is centralized, where experiments are incredibly expensive, whether they succeed or fail, and where over-communication leads to consensus that kills variance, kills weak beliefs. Number three, novelty compounds over time. That search for novelty, the hunt for surprises, is what makes the ecosystem so resilient, so vibrant. Innovations like eyes or tongue or lungs or touch, they might be considered improvements that help creatures survive and thrive, but they can also be viewed as the inevitable result of a search process that is accumulating knowledge about the world. If you keep trying new designs through mutation, through experimentation, eventually you'll discover that light is useful, that it exists and it's useful. Think about that in the way that we think about experimentation and venture building in organizations. Seeking surprises and gathering information, access to an ever wider array of building blocks is what enables more discoveries. The best innovations are those that enable and empower more innovations, more experimentation. So the lesson for organizations is simple, but it's really hard to execute. You've got to seek anomalies. Said differently, you have to seek novelty over time. You need serendipity to grow and to become resilient. To do that, to manufacture serendipity, you have to seek novelty to collect as much knowledge about the way the world works as you possibly can. Cheap and fast experimentation at the margins increases the likelihood that you'll encounter anomalies, and anomalies are the building blocks that lead to insight. Contrary to what a lot of us were taught in school or led to think, it's actually optimal to seek novelty for novelty's sake, no objective, within constraints, but without a clear plan for what might happen next. That sounds crazy. We'll talk more about that now. You convince your CFO to do this in a second. But the point is, do what is interesting, and good things are more likely to happen inside your organization. Your job as a corporate innovator is to be a professional insights gatherer, not a consensus builder. Spend a lot of our time building consensus. It's not your job. Your job is to be a professional insights gatherer. Now, experiments lead to the discovery of anomalies, those things that challenge what the organization believes to be true. And it's that collection of anomalies that creates a base of knowledge, and it's that knowledge that leads to insights. You should want more insights. And so if you want more insights, you need to run more experiments at the margins, like in the Amazon. In the face of an unknown future, the best way to maximize returns and minimize risk is to run as many experiments as you can at the lowest possible cost per experiment. You're gathering insights. You need to be thinking about, how do we run more experiments, and how do we do it faster? How do we do it for less, using less resources? More experiments, faster, cheaper, and weirder. Now, in the world of business, startups are fantastic experiment engines. They're optimized for it. They have incentive systems, talent, funding structures, governance mechanisms that are optimized for inefficiency, for learning, for making mistakes and learning from those mistakes. In contrast, scaled organizations are optimized for efficiency, for safety, and for execution. Now, here's where the opportunity exists for corporations. The trick is to leverage the best of both, to take advantage of the market access and understanding of large corporations while leveraging the learning ability of startups. I believe that corporations can do this through a systematic approach to venture building. Now, the most common failure mode to avoid here is trying, I see this all the time, is trying to build new ventures with the incentives, the talent, the funding, and governance systems that are designed to operate the scaled organization. New ventures require a dramatically different approach. It doesn't work to take all those systems to run the scaled organization to try and run the startups. They're fundamentally different things. But people try to do that all the time. Now, I put this slide in the deck We'll send out the slides after this. I put this in the deck mostly so those of you who get the deck after this presentation can have access to it. So one thing to consider when you're embarking on a path of venture building is to determine the guidelines for when ventures are launched internally inside the organization versus externally outside as independent entities. The approaches, as I just mentioned, are radically different. You can't do these things the same way. Internal ventures leverage the systems used to run the scaled business. External ventures leverage the systems used to run startups, and those two things are very, very different. In brief, summarize this. If a new venture is strategically critical to the future of the organization, meaning the viability of the organization depends on that new venture's success, you better control that thing really carefully. And you probably want to build it internally. On the other hand, if a new venture is merely strategically interesting, we don't know what's going to happen. It's a chance to learn about a new space. It's a chance to build optionality. You're probably better off building that externally. And that's a key filter for deciding which path these go through. And the result, the systems for each should be different. Now, if there's a single piece of advice I can give you when it comes to launching external ventures, it's this. Please don't constrain those new ventures strategically or financially. This is another failure mode we see all the time. Take a minority stake in that new business initially with the option to increase your stake over time. That sounds heretical, but there's a good reason for this. The goal when you're launching an external venture is to generate learning. It's not to generate safety. It's not to reinforce what you already know. You're trying to be surprised. If you want insights, if you want to be surprised, what you want to do is incentivize world-class entrepreneurs to move quickly and with relative autonomy. What we say all the time is you can't be both rich and king. Meaning you can become rich in terms of the learning, even the financial return you get from a new venture. That's much better than being in control. That new venture is going to be strategically constrained, look a lot like your existing business, or financially constrained, meaning no one else is ever going to invest in it. Quick example of how this works. A year ago, we launched a company called Amplio, one of our favorites. We've got, they're all like our kids. We love them all. Amplio's done really well. We built this company with Koch Industries. Koch Industries, they have many businesses. One of them is a large manufacturer of electrical components and connectors. And category leaders in that business, we're spending a lot of time trying to identify supply chain risks, trying to assess what's the chance that a part that I need is really going to show up next Tuesday. They were pulling data from a bunch of different sources to try and track this. And working with Koch, we identified a gap in the market around what we call proactive supply chain risk assessment. So we worked together to shape a bunch of different business concepts around this pain point. And we learned in speaking with many others in the industry, this was a widespread problem. It wasn't just Koch experiencing this. And so Koch had a choice. They could build an internal tool. There wasn't anything on the market for this, really. They could build an internal tool to solve the problem, or we could build an independent startup to solve it for everybody. Ultimately, we decided to launch Amplio as a startup, a software tool to help companies manage their static supply chain risk. And we recruited a fantastic founding team to run the company. We supported the company as it launched and as it grew. Koch provided the seed capital for Amplio. Koch's subsidiary signed on as the first customer for the company. And within a year, Amplio had signed on a bunch of other customers, and they raised a successful venture round with other new investors coming in at a substantial valuation increase. So Koch solved their business problem through a software subscription rather than having to build something internally. They saw their initial investment rise in value dramatically. And then Amplio, with Koch's backing as a customer and investor, achieved success more rapidly than it would have otherwise. High Alpha Innovation, we provided the support to the company as it scaled to help them move faster too. They had traction, success right out of the gates. In that type of scenario, everyone's a winner, right? Koch gained valuable learning about the market. They got a return on their investment. They solved an important business problem. Amplio is more likely to survive and succeed as a startup. And we benefited as a minority owner in that business alongside the others. When this works, it works really, really well. Your CFO wants you to do this. And this is kind of where I'll wrap up. We'll turn it to questions here in just a minute. It's hard to get budget for innovation because you're often competing with dollars that can be spent on other things with a predictable ROI and a predictable time to pay back. Innovation doesn't work that way, as we all know. Your CFO hates saying no all the time. And so Here's the secret to unlocking budget for venture building. Make it easy for your CFO to say yes. It's important to know there's two things that your CFO cares about. This is particularly true in a public company. One is your earnings, one is the multiple. These are the two factors that determine your stock price. As an innovation leader, you can help on both accounts. When it comes to earnings, you can remove the negative impact of innovation investment, the cost of running innovation, by moving it into new ventures, turning it into a balance sheet investment rather than an operating expense. Secondly, by experimenting in adjacent areas where the multiples are higher than in your core business, by demonstrating real traction in those areas, you can actually change public perception, change the story about your company while learning and while creating long-term strategic optionality for the business that increases the stock price by producing better multiples. We talk about that funding from the balance sheet just a little bit more detail. This is where we get a lot of questions on this. As I talked about, not every opportunity has exponential growth potential. They shouldn't all be spun out of the business. But we believe that independent external startup creation works best with transformational opportunities, those ideas that challenge the core business or compete against it in some way, where strategic alignment isn't clear in the beginning. Innovation is best funded as an operating expense when the ideas are close to the core business. That type of innovation requires capital that's impatient, right? When you're innovating close to the core, you can compete for budget with sure thing ROI requests. Like the operating business, that type of innovation is extremely capital efficient, or should be. A negative short-term impact on earnings is okay because the time to pay back is quick. Now, on the other hand, innovation is better funded from the balance sheet when it looks very different from, or when it challenges the core business in some way. These kinds of innovation need patient capital. It can wait for longer, wait a little bit longer for returns than operating expense. This kind of innovation requires a longer payback period because there's so much learning involved. The efficiency that can come later, initially it's going to be very inefficient in order to learn. These kinds of innovation can be set up in new ventures and funded as balance sheet investments with no negative impact on earnings. This is a big deal. You can tell your CFO that he or she can have both innovation and profits. You just need to run transformational innovation through external new entities. And even better, if you can leverage other investors' capital to do it alongside yours. You can do a lot more with a lot less. So CFOs love this approach in general. New ventures solve a lot of the problems that CFOs are trying to solve. Pursuing innovation in this way removes the negative impact innovation typically has on earnings. It drives higher multiples by changing the market perception through optionality and learning. When it's done properly, it leverages other people's capital, other people's expertise to make these things move faster. It's a really quick and inexpensive way for the organization to learn. And importantly for the CFO, they care about this a lot, is predictable. And what I mean by that, you can't predict the outcomes, but what you can predict, you can manage the downside risk. When you're building ventures externally, that downside risk is capped in the investment amount. It's not going to go beyond that. There's no annual recurring budget. It's capped. At the same time, the upside potential is not capped. This is really important. Also important, it enables the team that manages the core business to stay focused and not be distracted. A new venture's success or failure is up to the founding team that you're putting in to run that business. They should be properly incentivized to do it. When they are, they don't require access to the core business's systems of incentives or talent or governance. You can build new ventures externally, and you can help your CFO say yes to innovation this way and tap in, access more budget, which, especially in this environment, is a challenge. And with that, I'm going to put up my contact information. I've done enough talking. Let's go to Q&A. I'll put up my email. Feel free to reach out to me after this if you have specific questions or want to hop on a call. Happy to do it. But in the meantime, happy to answer any questions. I've been seeing some things come in, haven't been able to keep up with the chat. So Alex, maybe you can help me triage and we can jump into some of these.
Yeah, happy to do it. Elliott, great stuff. Everyone, thanks so much for submitting some great questions and comments in the chat. And again, we'll record everything and Elliott can follow up for things that we don't hit here. So let's go through these things kind of rapid fire, right? The first one, and you and I have talked about this, is language. And it's this idea of the venture studio. And some folks are now rebranding corporate innovation groups as venture studios. There's some that take equity, some that don't, charge fees, all of that sort of stuff. So just at a high level, a few minutes, how would you suggest folks think about like this world of venture studios? Like, what is it? What isn't it?
That's a good question. Time will tell where these definitions kind of land. Our view is that a venture studio is a combination of a build function plus a dedicated source of capital. It's that combination of a build team plus a venture fund forms a venture studio. It's very nuanced. In the end, it doesn't matter what people call it. What matters a lot more is the approach that people are taking to do this. Inside of corporations, I think there are specific models we see that work well and some that don't. Many that don't. Many more that don't. Address some of those today. So call it whatever you want. What's more important is to take the right approach. Mm-hmm. We call ourselves at High Alpha Innovation, by the way, a venture builder, which is a little bit broader in our view than a venture studio, which would require that dedicated fund.
Would you say there's circumstances in which internal venture groups within corporations are venture studios? Or is it just kind of a nomenclature?
Very rare in terms of my definition. We do see a lot of corporate innovation teams rebranding as venture studios. I think that's helpful for redirecting toward different approaches. But the reality is, as we talked about, a lot of internal corporate innovation teams face the challenge of having to duke it out for budget. Mm-hmm. In a dream world, I know from my experience, I would have loved to have had, I was working in corporate venture capital and innovation. I had to go fly. Our team had to go get approval from our CFO in Switzerland as things kind of slowed down to get approval for every investment or deal we wanted to do. It doesn't work. Ideally, a team's got a dedicated venture fund like we have in a venture studio that you can deploy with your own governance and decision-making. So that's a key difference. You've got the dedicated funding or you don't.
Great, thank you. Another word, insight. How would you define insight?
That's a good question. You can define a lot of different ways. I think that insights and building blocks are kind of, you can replace those words interchangeably. An insight is something upon which you learn that creates, let me reframe it a little bit. You think about job as a innovator is a professional insights gatherer. That means you're running a lot of experiments. The best experiments are those that lead you to discover new experiments you should go perform. In other words, if you're running an experiment, it reinforces what you already know. It's a bad experiment. It didn't identify any anomaly. It didn't produce an insight. So one way you might define an insight is it's a stepping stone to more information or knowledge.
Great, thank you. So now some questions around the model itself. An individual who's with us today talked about concerns around sending innovation outside, like outsourcing innovation. Are you externalizing learnings? Are you shortchanging internal capability building? How would you sort of address that concern that the outsource can actually negatively impact our ability to do innovation ourselves?
Yeah, the goal, I think we're in an environment where you should be trying every approach if you can. Because again, you don't know which activities are going to produce those unicorn insights that lead you into new directions. I think there's certainly a fear of outsourcing some of that venture building. Our view at High Alpha Innovation, our goal when we're working with corporations is to enable those corporations to become independent, world-class venture builders on their own. Long-term dependence on us isn't the answer for anybody. If we can create some new ventures together along the way, that's a win for us. But even better, we're on a mission to enable corporations to just be better at innovation. I think the world is better off when large-scale organizations can solve big problems. And right now, our scaled organizations are becoming worse at it. We need to improve that. So that's one level of kind of outsourcing. I think it's helpful to work with partners on venture building because those partners can provide protection and separation from the core. When it comes to those transformative innovations that need to launch externally, in particular, having other partners, other people's capital, other people's expertise involved can enable you to do more as a corporation with less. When it comes to those new ventures, you also need to think about how that learning makes its way back to the core business. And that's a really important thing. We didn't touch on that today. That's a really important part of the process. It's a mistake to just go build a bunch of things. One of the challenges historically of corporate venture capital is we go out and make a lot of investments and then find that it's actually really hard to bring those lessons back to the core business. And so in venture building, the good news is if you're proactively building new ventures, you can design businesses with your business challenges in mind, by default becoming a customer or a distribution partner of these new startups, you're incorporating some of those lessons along the way because it's baked in. But there are other more proactive things you can be doing to make sure those lessons are getting transferred back into the core.
Mhm. Great, thank you. So another one, building SaaS businesses, it's a natural fit for working with an external partner, a venture studio or a venture builder. We got a question about deep tech, about high capital intensity. Is it a model that works beyond SaaS, works effectively?
Yeah, totally. Yeah, the playbook works. In fact, some of the biggest examples of success that we see in kind of that venture studio, venture building model are in the world of biotech. Incredibly expensive investments up front, long cycles to pay back in terms of revenue, lots of uncertainty. The model works extraordinarily well. So it also works in deep tech. At High Alpha Innovation, we started out B2B SaaS just from an investment perspective. We love the infinite scalability of B2B and predictability of B2B software. But the playbook, it turns out, works also in deep tech. The challenge is the timelines and the investments and amounts are a little harder to predict. And so if you can build some good rules of thumb around those, the playbook works really, really well in those circumstances too.
This is somewhat related. We got a question about, industries like government, defense, intel, et cetera, customer base and fields right for new ventures and innovation, but there's a lot of risk aversion in those industries. So any quick thoughts about that side of things?
Yeah, push experimentation to the margins where failure doesn't impact the core business, right? I remember speaking to a corporate innovation leader once who said, we're really good at failing slowly and at scale inside our company. That is not the way to do it. So again, think about that example of the Amazon jungle, the ecosystem. Innovation, experimentation happens at the level of the cell or the organism. What's the equivalent in your ecosystem inside your company? If you're looking at some of these spaces where it's just riskier, it's highly regulated. You make mistakes and people's lives are at risk. Experimentation is harder to centralize. And so you have to figure out ways that the mandate's even stronger to push that experimentation out to the margins. External startups are a fantastic way to do that. In the world of business, external startups are the form of independent organisms, where if that startup dies, the core organization's fine. But if it works, the core organization's poised to take that mutation and run with it.
So building off of that, you got a lot of folks interested in your the ecosystem analogy, Amazon. We had one comment, in the Amazon, many branches of experimentation perish, have to be many infinite cycles of innovation and adaptation. Think about Google's program of rewarding teams who kill projects early. This is so brave and probably luxury many internal innovation teams wish they had. So a lot of aspiration, but not a lot of reality for folks.
Yeah, I think it's scary when the historic cost of experimentation is high. And the cost is high when you're doing that experimentation internally. So your job as a corporate innovator is to be a professional insights gatherer, which means you need to be running as many experiments as possible at the lowest possible cost per experiment. A good place to start is to ask the question, how do we lower the cost of our average experiment that we're running so that we can run more of them? Because when those things don't work out, you're gathering the insights, moving on to the next thing. It's not a big deal. It becomes less scary to kill that stuff. That whole branch of evolution dies. That's okay. It didn't cost that much. We've got 42 other ones, and it's okay. When you're putting all your eggs in one basket, that's scary. And that's what happens when that innovation, that experimentation is centralized.
Yeah, it's interesting. We got a couple of folks who are making the comment that corporation leaders want high alpha, low beta, or lower beta.
Yeah,
characterize it.
Yes, you understand the name.
Another person asked, so going off of your slide about how a corporate innovator should be professional insights gatherers, the experiments, anomalies, et cetera. How do you balance all this with the notion that pure science experiments rarely lead to solid businesses? So folks who go to that side of experimentation, engineers, technologists running loose, doing experiments, but it's not tied maybe to being human or customer centered.
Yeah. This is that's a super interesting topic on its own. What we're seeing across science broadly. Here's a statistic just to throw out. 90% of the scientists who have ever lived on the planet are alive today. 90%. Every scientist who's ever lived is alive today. But we haven't seen an equal increase in the number of scientific breakthroughs. Now, the pace has increased for sure, and it continues to increase, but it's not increasing at that pace. And the lesson is that science overall is becoming perhaps less efficient. And there are a lot of theories about why that is and what to do about it. A lot of implications for what this means for companies. R&D inside of large corporations, 41 times less effective than it was 100 years ago. Something's broken, something's changed. And part of the view is over time, it's become much more of a top-down, broadly, the way that science gets funded both externally and within companies, science has become more of a top-down, centrally managed affair. Think about how this works in companies. 100 years ago, there was a lot more freedom for people to just run around and do crazy things. Over time, as organizations have scaled and oriented more towards safety and predictability, that becomes a lot scarier. The irony of it is that that old approach was actually more efficient at producing breakthroughs and new business models. So again, the question is, how do we run more experiments faster, cheaper, weirder? There's just a ton of great examples out there from individuals, organizations. I talked about the need to pursue novelty for novelty's sake without objectives, within the constraints that you have to operate in, but without objectives. It's actually, ironically, a more efficient way to produce breakthroughs. It doesn't feel like it. And it's really hard to tell your CFO, we just want to go see what happens. And we're going to go play with all these things. But if you look at the data, that actually works better. And so again, you're never going to convince your leadership team at a big company to let you go do that, to just go play and see what happens. You've got to figure out a way to get as close to that as you can. The trick is to figure out a way, again, to lower the cost per experiment, go run as many experiments as you can. Sending a lot of those outside the organization is a good way to do that.
By the way, a number of folks love the fact that you're empowering weird and weirdos, because there's a lot of folks who
weirdos unite. Let's go. Yeah,
exactly. A couple more. So the incentives question, and again, a number of folks noted just this misalignment of incentives in corporates. And so, you and I have talked about this a little bit, which is some of those misalignments unconquerable, right? In terms of the incentives for the organization to keep doing what it does and perpetuate itself versus the desire to build new things. And so ultimately, do you think organizations can have much success trying to build these new break the business or capability model things internally, or will the antibodies, the misalignment of incentives, always suboptimize it? And so at some point, these things have to go to external partners. You think that's
for certain types of innovation, my belief is it does have to go externally, and it should go external. Not only does it have to, it should, because we've talked about the scaled organization over time. Every big company began as a startup, right? Running crazy, trying to do all sorts of things, figure out what sticks. You find something that sticks, amazing. You get product market fit, that startup takes off. Over time, that startup becomes a large organization and puts in place rules and practices to preserve what has worked and to optimize for safety and predictability. Jack Welch, CEO of GE, once said, variance is evil. And he used that theory to manage GE. The idea, we're going to eradicate mistakes from this place. We're going to go to Six Sigma. Everything's going to be predictable. And it turns out over time, in retrospect, that's a terrible way to run a scaled organization. Now, unless there are exceptions to that, right? I go to the hospital. I want that hospital to be operating at Six Sigma. I don't want them making mistakes. But if it's GE, you can ask the question. There's a certain amount of inefficiency, of natural chaos, that is probably appropriate in a large organization like that to enable it to learn. If they're not making mistakes, the organization isn't learning. They're not innovating. They're doing process improvements, but that's never going to transform or create new business models. So you have to have a serious discussion with the leadership team. What's the appropriate amount of chaos and inefficiency we're willing to accept? The CFO is going to say none. We want to be super capital efficient, in which case you've got the solution that says, well, let's push some of this experimentation and learning and mistake making outside the organization then. Let's do this in the form of external ventures where that downside risk is capped, the upside potential is not. The core business can continue to operate without the distraction. And that's kind of how you balance both, in my view.
Great, thank you. We'll hit at least one more. So the CFO. So, some years ago, there was a lot written about how the chief information officer, right, that role is evolving. There was the whole idea of, keeping the lights on. There was the whole idea of, okay, cutting cost. And then this idea that chief information officers really need to be thinking about innovation, right? How do you create business value through IT? The CFO, a lot of folks have noted that, the CFO is, again, a great quote here. The CFO is typically not tasked with innovation, just controlling the cost of it. So are you seeing the CFO role evolve? Do you have some thoughts about where it needs to go and how the folks who've joined us can help sort of shape or encourage their CFO in the right direction?
No, I think there's a big philosophical discussion behind that question. I think just around the nature of corporations and what they're intended to do. Limited liability corporation is one of the greatest inventions in the history of mankind. In terms of a human's ability to come together and just agree on a piece of paper and a contract and create these structures that can do incredible things like build the laptops that we're talking to each other on right now. That's amazing. That said, there are probably some ways that corporate structure could be improved, and I hope will be improved in the future, that creates different dynamics and incentives for those involved. Right now, as Clay Christensen so wonderfully articulated prior to his passing, he talked about this idea of the capitalist dilemma, that we use the wrong metrics to determine the success of companies. And what he talked about is we use return on invested capital as a primary metric to determine whether a company is successful. And if you look at that, what that does is it forces companies to optimize for safety and predictability and all these things we talked about. The hunches, the hypothesis, that's probably not the right metric. But that metric is driven in part by the way that our corporations are formed and set up today. So my hope is that in the future, somebody smart is going to figure out new approaches that will result in new metrics that help us understand sometimes safety is not the right answer. I saw a friend once with a shirt that said safety second. I think that applies in our corporations more than we probably think it does.
We also got a suggestion that there should be coffee mugs which say, "I am fast, cheap, and weird." So that's
that's such a good idea.
Maybe one more stepping back, and then again, everybody, thank you so much. We're capturing all of this, so Elliott and the team can follow up. So ultimately, I mean, Elliott, you and the team have conversations with a lot of different organizations who might be interested in working with you. How do you step back and assess? What are some of your evaluative criteria to figure out whether there's a high probability of success, whether it's the right kind of partner for High Alpha?
Yeah, we work with a broad range of organizations that are all different levels and stages of venture building or innovation, period. We have companies that come to us and say, "Hey, we just need more innovation. We don't know where to look for it." We can start there. We have other organizations come to us, say, we built this thing. We think maybe it could move faster, or maybe it could spin out and be more successful, and everything in between. We can jump in at any point and to deploy the playbook to help corporations accelerate their efforts. What I will say is that it works better, as everyone on this call knows, when you have the support of a leadership team. When you're ready, you have kind of pathways, ideas about where capital might come from. Should you want to invest in these new ventures that get formed? You don't have to, but should you want to, you ought to be thinking about where that capital might come from beforehand. It's helpful. And then I think having an understanding of why venture building makes sense in the context of the strategy of the corporation is really important. We can help with all of those things and can help you communicate that to your leadership team if your desire is to get more serious about venture building. Let us help you. We've learned a lot about how to communicate this along the way, and have a team that's pretty good at it.
Wonderful. Elliott, thank you so much. And I really appreciate your time. Everybody, again, who joined us, thank you so much for the questions and the comments. As I said, capturing all of this so we can get back in touch with you. The replay and the slides will be available, and we can also help you follow up with Elliott directly. But Elliott, great to see you. Thanks so much. And everyone who's joined us, thank you so much for joining us. Have a wonderful rest of your day. We appreciate it.
See y'all. Thanks.